You may recall that a few months ago I did a video on a particular system of mine that spent most of last year in Drawdown, and I do plan on doing an update to that video to show some of the alterations, not necessarily in the system that I made, but more in my thinking about the system and the way I implemented it. But I thought in the interim I would do, let's call it a little bit of a half-time update. And I'm doing this because what I want to convey is the importance of sticking with a system that works during drawdown. So the first point I will make is that all systems draw down. It is a natural feature of trading. I will reiterate again that anyone who approaches you and says they have a system that does not draw down or only draws down 1 or 2% is either delusional or is a liar. It's probably the second one. And anyone who falls for that lie is either stupid or mentally infirm, or both. And there is no such thing as a no drawdown system. But what I need to convey is it is necessary to stick with your system during drawdown, because if you do not, then you will not be placed to take advantage of that trade that comes along that puts the brakes on the drawdown. And this is one particular trade from this system of mine which put the brakes on my drawdown. And what I want to do is walk through the thinking behind what I was doing with the trade. The trade in particular is Chicago wheat. This is a 4-hour system, so it trades 4-hour data. This is the complete picture. You can see that price was in an uptrend, price faltered, fell, there was a gap down partway through the fall, price accelerated, that part of the move ended, price consolidated again, and then fell away again. In real time, what I was seeing was this gap up. Gaps are an important point in trading because they're trying to tell you a story, and they tell you a story in two ways. The first is if the gap is successful. If the gap is successful, they're very powerful signals. If the gap fails, that is also a powerful signal. We come back to this thing that price will tell you everything you need to know. You just need to know how to listen. But more importantly, you need to approach listening with an open mind. When I saw this initial gap, I understood that it was part of an uptrend. But the gap itself did not clear the previous high. What I would have wanted to see to consider this as an explosive gap was a move beyond this previous high. We come back to this notion again that prices making new highs in an uptrend is a good thing. All too often people regard price making new highs in an uptrend as a bad thing. You have to be courageous enough to buy highs as they occur, because, again, we come back to the old mantra. It's telling you something. This was, to me, a continuation gap. So it hadn't altered my thinking when I first saw it appear. I didn't instantly see the gap and start to panic, because it is part of this particular uptrend. What caught my attention was that the gap was quickly filled. Whenever a gap is filled very quickly, such as in this instance, you get a sense of what the psychology of the market is. And the psychology of the market is that people are not convinced about that gap and they fill it very quickly. For this to be a true continuation move, price should have continued on. That would have been, you don't want to call it the default setting for your expectation, but on the balance of probability, one might expect that gaps continue on. When they don't, you're being told a very important story. Price then moves past the low that occurred before the gap. So again, this is telling you something important. It's telling you that in this particular instance, traders are not comfortable with price moving up. And in fact, we've had what I would consider a shift in psychology. We have moved from bullish to bearish. So now you are set and primed to look for a reason to be bearish. You're looking for a trigger. The background is telling you that the market is bearish, therefore you should be bearish, therefore you should be looking for something that triggers you in, that forces you to take action. And we come to this notion that every moment of every day, the market presents you with an opportunity. So when I saw this, I understood that the question the market was asking me was, do you wish to go short, yes or no? And everybody else looking at this same chart would be being asked the same question. And it would continue to ask me that question. Think of it this way. If you are long a particular stock that continually sets new highs every day, every time it does that, the market asks you a simple question. Do you wish to participate, yes or no? And it will keep asking you that question right up until the moment the move ends. Sadly, it is at that point when the move ends that most people go, yes, I'd like to be involved. This occurs because of this need that traders have for confirmation. The question I would therefore ask you and get yourself to ask is, how much confirmation do you need? I have had conversations with people who have said that they require at least 2 years of confirmation. Well, good luck with that, because that's never going to happen. When we trade, we operate in an imperfect environment. And it is imperfect because decision-making is based around 3 concepts. The time you have to make the decision, your cognitive ability, and I lump emotional ability in this, and the quality of the information you receive. In trading, none of those are infinite. So you have to make your decisions in an imperfect environment, which is what we want, because an imperfect environment conveys risk. Risk conveys the potential for reward. As price fell away from this, I'm now short. So my position is now short. I want this to continue falling. That's my outlook. That's what I want. This move down then accelerates because we get this gap. The gap is in the direction of the underlying trend. The gap does not fail. So the rule here is add to this position with size. I understand that that is uncomfortable for people. And it is uncomfortable because I come back to my earlier point. Everything we do is imperfect. You deal with the imperfection. Trading is dirty. It is not crystal clear. It is not cut and dried. But that's why we have money management. My stop was hit down here as price reversed, and we got this somewhat dirty little batch of consolidation. For me, the important thing to note here is that whilst this particular trade was knocked out, the long-term trend or the background filter I have for this had not shifted from being bearish. Therefore, with it still in place, I don't go long. I don't stop and reverse. I'm not a fan of stop and reverse systems. They're very good for keeping you entertained and thinking that you're part of the action and you're continually doing something. But what you're doing is spending a lot of time spinning your wheels in the mud. And as I record this, I'm now short again. I'm short again because price has broken below that low. The consolidation has failed. The background trend is still in place for me. So once again, I look to act against the background trend, not the noise that occurs on very short-term timeframes. So what's the upshot of this? The upshot of this is that all systems encounter drawdown. It's just the way it is. Drawdown is distressing for traders because if they're extended, they introduce doubt and they cause people to second-guess themselves in the system. If you have a system that in the past has been functional and has gone into drawdown, the way you deal with that is simply adopting the approach of anybody in business, because sometimes it is a bad time to be a producer of red widgets. There are times when people want blue widgets, not red ones. But that will change, and so you just have to keep going and you have to keep taking the trades. All too often I've seen people enter drawdown and either stop trading completely. That in and of itself is probably a good thing for them because it demonstrates that they don't have the resilience or durability to trade. But the second thing they do is begin to swap systems, thinking that a new system will somehow drag themselves out of drawdown. They completely forget that the old system did work. It's just that the system is undergoing part of its natural cycle. Sometimes you get it wrong. Sometimes you fall out of rhythm with the market. And yes, sometimes you have to review what you are doing, but more often than not, if there's not something wrong with the system, you actually have to review what you're doing. And as my follow-up video to this, where I look at what has happened post my drawdown, you will see that a lot of the things I have changed relate to my thinking. The way I present a chart like this has not changed. You will notice it is not plastered with indicators and all sorts of bullshit things like an awesome oscillator on this and God's best green apples tool and all that nonsense that people who think they can trade go along with. It's simply price. What I've had to do is to work out why my interaction with the system last year was so poor. What was I doing? And in part, and this is a little bit of a spoiler alert, I was doing what a lot of people do, and that is taking trades that were suboptimal. So I was trading things that were not quite there. I'd fallen into the trap of trading what I wanted to see, not what was there. But back to this, and back to my title slide, the reality of drawdown and the reality of trading is it only takes one good trade. But if you're not in a position to take that one good trade because you've either changed the system and not seen it, or you've given up, or your psychology hasn't recovered, then you never get to experience the notion of what climbing out of drawdown is like. And climbing out of drawdown is a very powerful learning experience for traders, because you can store that in the back of your mind and say to yourself, well, I've seen this before. It doesn't really matter because I've climbed out of it before.